Joining us today is UBS Global Wealth Management CIO Mark Heffley. Mark, it's good to see you. Do you expect the 10-year to once again test that sort of 4.88 level?
Well, the 10-year could test it because growth in the U.S. has been stronger than anticipated. But that said, we think over the course of the next year, the 10-year will fall as growth continues to slow in the U.S.
What is your year-end 23 and maybe 24 target on the benchmark?
Yeah. Well, look, I think this is a great time for people to get their portfolios more in balance because we see positive returns across cash, bonds, and equities. So, when we look out towards the middle of next year, we could see the S&P 500 probably about 4,500, and we could see the 10-year at about 3.5.
3.5. Am I reading this right? Do you see maybe a downside scenario on the 10-year to below 3?
Yeah, I mean, if we have a hard landing, you get back towards R-star plus long-term inflation rates, you could get lower than that.
So, Mark, why are you so convinced that bond yields are going to make a turnaround here? Everybody's expecting growth to weaken as these Fed hikes catch up to the economy, and yet yields continue to move higher.
Yeah, I think, when we analyze it, if you look at this, there's a lot of noise. Well, supply and demand is an issue, and certainly supply is higher, and that's a concern. But the bond vigilantes, are not really going after the United States here. It's not like anybody's worried that the United States is going to default. Credit default swaps for the U.S. are stable. If you look at inflation rates, longer-term inflation rates have not really moved recently. They were a cause for bond yields to move earlier in the year, and what that leaves us with is high short-term rates, and then this view that the U.S. economy is stronger, and so the marginal buyer was somebody who believed that the U.S. economy was going to enter a recession this year, and that person's perhaps stepped away in the past few months, and that's led the longer-term rates to go up. But as inflation remains under control and gets closer to the Fed target, maybe the Fed can start to talk a little bit more about stabilization of rates and lower rates, and that should take some of the pressure off the long end of the curve.
But you don't think they're near doing that at this point yet, are they? We've just had some firmer CPI readings, PPI readings. Inflation expectations ticked up for 5 and 10-year in the University of Michigan.
Yeah, I mean, I recognize the sentiment data today, but I think the broader story of inflation slowing and the U.S. economy slowing will ultimately trump some of these shorter-term factors that have driven rates up recently.
If all this is true, what happens to the dollar?
Well, we had been believing that, say, the euro was going to do better for a long time. But when we listened to what the ECB was saying and the Fed was saying, now it's really unclear who's going to be cutting first. And so the dollar, we're neutral on the dollar versus the euro because of the geopolitical concerns and also a much more unclear picture about who's going to be cutting first. So right now, I'd say neutral on the dollar. The currencies we like are some of these more commodity-focused currencies like the Canadian dollar or the Australian dollar.